Welcome back, traders. This is Sandra with Trading Made Simple, and today we're going to talk about selling credit spreads. Today we're going to learn about this high probability short-term income generating stream. We're going to talk about the entries of this techniques, how we're just using basic overbought and oversold levels, as well as support and resistance, things that you already probably know about, as well as how to apply those techniques with weekly options. By the way, if you haven't already, smash that like button and subscribe. Please do so. I really do appreciate you supporting this channel. Now, option time decay. By selling options, the rapid time decay, especially in the last week, work in our favor of selling credit spreads. Selling weekly options, monthly options, SPX, large caps are a strategy for both small and large accounts looking to make consistent income. A lot of people don't know that large institutions like Goldman Sachs, as an example, hedge funds, what they do is they buy large blocks of stock. And then when you're on the open market as a retail investor trying to buy that stock or option, what they do is that spread that you see at the bottom of your trading platform that says bid and ask. Well, the difference between those two, which is basically pennies to a little bit of money, they are actually profiting from that. That's how they generate capital for their companies. And the second way that they do that is by selling puts as well as selling credit spreads. I'm clicking a mouse, trying to get to the next slide. Think about this. By selling weekly options, the hyper-fast time decay works in your favor. Now, when we look at time decay as it erodes, you can see at the very last segment, it evaporates very, very quickly. And that's good for option sellers because as option buyers, we always learn that theta works against us. But when you're an option seller acting like the casino, theta actually works for us. We like the time decay. We want it to expire worthless because we get our credit up front. As soon as you sell that option spread, you get a credit. And your goal is for that option spread to be worthless at expiration, and you get the entire spread. But like any other option, you can sell it prior to the expiration date and still make a profit. That's the clicking in the background. No naked selling. So I know people that actually sell puts and they are doing really well. You know, I guess I'm just biased, but my experience in education, I've just been taught not to sell naked. And what that means is that you're selling an option and you have no protection. So your risk amount can be infinite. And because of that, I don't. But I do sell credit spreads because they are protected. So an option spread, which is very common, is a strategy used to minimize risk or bet on a various market outcome. Whether the market goes higher or lower, you're still betting on basically a direction using two or more options. In selling a vertical spread, you basically are you're selling one option and you're purchasing another, but they're the same type of option. So if you're selling calls, you're selling a call and you're selling and you're buying a call. Of course, I have to make this part difficult because I'm tongue-tied. But anyway, so it's always easier to understand than it is to actually write it all down. But I really do think that I made this as simple as possible, but in any event, a vertical spread, you're basically selling a call and you're buying a call. You're selling a put and then you're buying a put. And that buying of that option, as an example, is your protection, okay? So that there's limited risk. And because there's limited risk, that's a nice, feeling of protection. So when you're selling a bull put credit spread, you profit when the price rises. And when you're selling a bear call credit spread, you profit when it falls. So if you're an option buyer right now and you've purchased calls and you've purchased puts and you're making a directional bet on a stock, you just need to think that when you're selling, you're just going in the opposite direction. So when you're selling a call spread, you're wanting the direction to go down. And when you're selling a put spread, you're wanting the direction to go up. So why SPX weekly option trades? Well, let me tell you. There's high volume, high liquidity. You can get in and out quickly. It's not like if you've ever been to Hotel California where you can get in, but you can't get out. If you've purchased any options with a symbol that doesn't have liquidity or volume, then you know exactly what I'm talking about. So having high liquidity is important for option sellers as well as buyers, by the way. And then it's always nice to have a tight bid and ask spread. So there's not a lot of slippage. And so that means that you're getting out with most of your profit. Now check with your tax professional, because I have read some information that says that it could be better at the end of the year in taxes for your capital gains if you're just utilizing SPX as an example versus Google or any other stock. So please check with your tax professional, because you know that I am not a financial advisor and that this is just education for you to understand more about selling credit spreads. The other benefit too about SPX weekly option trades is that there's no assignment of stock. So when or if the stock price starts to breach your short spread, there's no anxiety about you having to own any of that stock. It's a cash settled fund. So that's one benefit as well to the SPX. So let's now, as you hear the clicking in the background, having a hell of a night with this. Come on, baby. So let's take a look at the bell curve. So what makes credit spreads really good and profitable is that they are high probability trades. So this is a bell curve as an example. And so when we take a look at a stock symbol, there is a first deviation and a second deviation and a third deviation, and it's basically the movement of the stock. So if a stock moves within the first deviation band, that's a 68.2% probability of a win. If it happens to go outside the second probability band, and you're able to detect what direction it's going next, that's a 95% win ratio. Because remember that we're still picking a direction. So this actually applies in any type of option strategy that you're utilizing. And I think that's why overbought and oversold as well as support and resistance are so popular. And they're old school, by the way. And it's because if the stock gets to its full range of the second deviation as an example, the likelihood of it going to the third deviation is very small. Even if it gets to the first deviation, you could see what the percentage rate is of getting past that first deviation to the second deviation. And so knowing that already gives you an edge as far as your win ratio for the trade. So how to get in and out of trades? Let's check out the chart of SPX today and see what that looks like. Let's make this simple. How do we choose our entries and exits? Well, utilizing a tool that is a deviation channel will help you. And so when you go into a toss to get your tool, pick one that you are attracted to. Now, there's so many different deviation channels to choose from. There's the Bollinger Bands, the Keltner channel. There's, if you just go into deviation channel, you can see all the deviation channels. My favorite is the TTM LRC. And you want to use the one that you feel comfortable with, that you can analyze and recognize the bell curve that's going on, because that's exactly what this is. This is the first standard deviation of the bell curve, and this is the second standard deviation for the bell curve. And 68% of the time, price stays within that first deviation channel. And then, 20 what, 7 point something percent, chances are that it will go outside of that deviation channel. And then there's a, 0.2% as an example. There's a 0.2% that it will actually go outside of the second deviation. And so knowing those probabilities should help you in your trading, especially when you're selling credit spreads. Because if we can see the deviation channel, we can then identify how it's been behaving, and then choose the most appropriate spot for us to know, hey, this is a good spot for us to sell a credit spread. And not only are we going to sell a credit spread knowing that it's consolidating right here, it's not passing its first deviation, but we're going to give it some cushion. And cushion in this sense means protection, right? And we can also see where price is as time is moving. So as time is going forward, we can see the direction the deviation channel is, and sell a credit spread just above it in this example, and or sell a puts credit spread in this example just below it at the second deviation channel. And so that allows you to pinpoint your entries and exits. Could you also set an alarm now that you're looking at this channel? And let's say we don't want to make a trade when price is at the mean, because it could reverse. We don't know if it's going to continue down or reverse back up. And you can see, there's a better probability of me making a trade when price touches first deviation channel. So you can set an alert so that when price does touch the deviation channel, you then could identify your trade and pick a cushion staying within those probabilities to create the best outcome for your trading. All right, so step one is to place a directional credit spread trade when SPX is either overbought or oversold. And using support and resistance helps you do that. I mean, that really is what a regression channel is. It's showing you the channel of movement that it's using, and you can use that for your benefit regardless of what strategy you're using. So step two is to exit a profitable trade. You don't have to let it expire. When you see a measured move in your direction and you have profit, then look at the overbought and oversold levels to make sure that the trend that you think it's going in or has gone in is going to continue. If there's an EMA cross, these are some of the, indicators that will help you in determining when to exit that trade. So even though it's wonderful if you leave your trade on till expiration to get the entire credit, we don't want to be greedy and we don't want to lose the profit that we've made. So looking at those types of indicators to assist you when exiting is important, just like using the Fibonacci extensions to show you what that measured move might look like when it's going in your direction and where it might end. And of course, tips. Risk management. Use 1.5% of your account value per trade. ID your risk in the trade and know your profit exit. And if direction is going against you, it's time to close out that trade and preserve capital. So we've discussed how important that regression channel is, really trying to analyze and identify with that channel, how price actually reacts to that channel and how you could use that for your benefit, right? Support and resistance. And then the chart trend, you need to watch that and be familiar with that, knowing how price is moving. Is it in a bullish trend with higher highs or a bearish trend with lower lows? And then use the Fibonacci extension on the chart to see possible exits. So before investing, please make sure that by the way, you talk to a financial advisor. I am not a financial advisor. I'm not a tax professional. So I'm just here to create educational videos and to help you with learning something new. So before investing, know what your broker's limitations are. Do you need a margin account to trade spreads? What are your day trade limitations if you have less than a $25,000 account and you want to trade spreads? Because if you need to get out of a trade in one day, you've gotten into the trade today and you need to get out of that trade today, is that considered a day trade if you have less than $25,000? So these are the things that you're going to want to know so that you can basically manage your account. And then, of course, the cost of contracts. A lot of different brokers charge different prices for contracts. And if this is something that you're doing weekly as well as maybe 3 times a week, because the SPX expires on Monday, Wednesdays, and Fridays, you might be buying, as an example, 10 to 20 contracts at a time. Is it worth you looking into another broker to see if they're charging less? Because in the long run, that may be a good decision for you. Can you stay with your current broker just to check out the charts and the indicators and stuff like that? Absolutely. But just know that, that might be something to look into for you as far as your, managing your account. And then setting expectations. This is a slow and steady income generating machine, basically. This is not like, get in, get out quick, day trade type stuff. Really, this is something that can be used for people that just want to look at the chart once a day. It's manageable. You can determine how many trades you want to get into. You know that SPX, as an example, expires Monday, Wednesday, Fridays. Doesn't mean you have to be in a trade every single expiration. You can be in one once a week if you wanted to and still generate income. So I guess, this is something that's just more manageable for a working adult, not a day trader. This is not a day trading type of strategy. But are there strategies to sell credit spreads and have them be a zero expiration dated trade? Absolutely. There are so many different options, but today, today we're just talking about this one strategy. So just remember, slow and steady, there's always losses, and controlling those losses by exiting those positions to protect your capital is important when they're going against you. When you provide yourself with a cushion, by the way, when we talk about a high probability trade, because we have a cushion between the current price of the stock and the strike price that you chose to sell that credit spread, it creates a higher probability trade for you, but it also creates a larger risk than the credit you receive. So you could receive, as an example, $25 of credit per contract, but your full risk on the trade might be $400. And so a lot of people think that, wow, that's like crazy. But really, because it's a high probability trade, you are just expected to carry more risk with that trade. It's a deterrent, there's no doubt. But it's something you just need to be aware of and manage. So what does that look like? We looked at the regression channel. You're going to make a decision. As an example, if we were right here today, if I was to buy a call spread, thinking that this was going to go down, and I was going to create that spread around the second deviation band, that would be around the 44.40, 44.45. If you go to the trade tab today and you look at 44.40, you'll see that 44.40, 44.45 is a 94.5% probability that trade is going to be successful. And the way you find that out is you just go to your trade tab. You put this on single. You just want to look at the option just like a regular call and put. And then you go down to the one that you're going to sell. And the strike price that you're going to sell is the 44.40. And when you look at the 44.40, you just go right underneath the probability of out of the money, because that's what we want to do. We want to stay out of the money. We're selling this out of the money. We want to stay out of the money to get our credit. And so by doing that, you go right over here and you could see that it's a 94.5% probability that trade is going to be a winner. I must have too many windows open. It's crazy. Okay. So originally, we looked at the regression channel. We chose the 44.40, 44.45 based on just the regression channel alone. We're getting a 25-cent credit for each contract. So that means that our sold strike price, you can see that we sold the 44.40. We purchased the 44.45 call, and we got a $25 credit. That credit goes automatically in your account as soon as you get filled. And that short strike is 89 points away from the price of the stock. So plenty of cushion. So when you go to confirm that trade, your break-even price is at the 44.40.25. Your max profit is 25. And look at your max loss. It's $475. You can also see how much commission and fees you're paying for that. So let's say we pick a different strike. We looked at the regression channel, and now we're looking at the trade tab. And if you've never looked at your trade tab in detail, right up here is a percentage, and that's the IV percentage. The higher the IV, the higher credit you're going to get. And the reason is because IV is really about swings and movements. So the higher IV, the higher volatile the stock is, which means that those swings, there's a higher probability that those swings are going to happen. And because of that, they're paying you more to take on that risk. So in this example, I've chosen the 44.15 and the 44.20. And the reason is because the market makers, just like bookies, they have this figured out. They've estimated that for this option to expire this Friday, They tell you what the implied volatility is, and then they've estimated that this stock is going to be plus or minus 65 points. So because we've picked a direction, and that direction being that it's going to go down, 65 points away on the downside of where the stock is right now would be at the 44.15 level. So if we sold a 44.15, 44.20, that's a 87.5% probability of success. And what does that say? 65 cents, 60 or 65 cents for the credit. So that's a larger credit because we're at a shorter distance away, but we're taking into consideration the implied volatility and what the market makers have indicated of a plus or minus for the option. Now, when we take a look at that 44.15 spread that we chose, you could see that the max profit was 60 cents or $60 per each contract. The max loss is 440. So again, higher probability trade, larger risk of loss. That's why managing those trades are very important. So how did I know that it was a 87.5 probability? You just place your trade tab on single as if you were buying the call or put, and you look up 44.15, you look over the probability of out of the money, and you can see what percentage of probability of success that trade would be in. So again, I'm not a financial advisor, so please consult with your financial professional for investment advice. This is information, educational, as well as entertaining to help you understand selling credit spreads. You know, selling credit spreads, when people know it, it seems easy to them. But when you're learning it, or even, by the way, trying to teach it, I can tell you that it seems a little bit more difficult than it really is. So if you have any additional questions, don't hesitate to email me. You know I always get back to you with your questions. Please subscribe, and you'll get notified of some upcoming videos. I hope I made this simple. Hope I saved you some money or made you some money. Have a great night, and we'll see you on the next video.